Now, when you use income method to measure national income, certain precautions must be taken, or you must take certain precautions while using income method to calculate national income. First and basic precaution by using income method is sale and purchase of second-hand goods never included in the estimation of national income, because it creates the problem of double counting. But commission paid on the sale and purchase of second-hand goods always included in the estimation of national income. Transfer earning, transfer payments are never included in the estimation of national income, because these are one-sided income or payment which not to be included in the estimation of national income. Now, windfall gains or windfall losses never included in the estimation of national income, because it is certain getting income. It is you are not working for it, you suddenly gets this income, like income from lottery. Similarly, income from illegal activities like gambling, smuggling, theft never included in the estimation of national income. Another precaution of the income method is compensation of employees include three parts: wages, salary, social security contribution, retirement pension. If all these three parts are given, you have to add only compensation of employees, because its sub parts are only the parts of compensation of employees. Similarly, if profit and its parts are given, only profit to be included in the estimation of national income, and indirect taxes are never included in the estimation of national income, because it only increases the price of the commodity. Another method is expenditure method of calculating national income. It is that method which measures national income by adding expenditure made by the people of a country to purchase gross domestic product or to purchase domestically produced goods in an economy in an accounting year, but it includes only expenditure on final goods, not the expenditure on intermediate goods. Now, the components of expenditure, or what is to be included while calculating national income by expenditure method. First is private final consumption expenditure. It means expenditure by household sector and non-profit institutions serving household sector to purchase durable, non-durable and semi-durable goods and services. Government final consumption expenditure. It includes expenditure by the government to maintain law and order and purchase goods and services for its own departments. Third component of the expenditure method is gross domestic capital formation. It includes total investment in an economy in an accounting year. Basically, gross domestic capital formation includes gross domestic fixed capital formation and change in stock. Gross domestic fixed capital formation means total investment in the fixed assets. This investment is made by household sector, business sector and government sector. Household sector make fixed investment in the houses, shops, whereas business makes fixed investment in the plant and machinery, and government makes fixed investment in the roads, dams, bridges, etc. Now, how to calculate national income by expenditure method? In order to calculate national income by expenditure method, first of all, try to find out GDP by expenditure method. In order to find the GDP by expenditure method, you have to add the four components, that is private final consumption expenditure, government final consumption expenditure, gross domestic capital formation and net exports. By adding these, you are able to find GDP MP, deduct depreciation, deduct net indirect taxes and add net factor income from abroad. Then you are able to find national income by expenditure method. Now, there is one question regarding this method is double counting or problem of double counting, and how to avoid the problem of double counting. Problem of double counting by we mean when value of same product added twice in the national income. Means value of one product added two times in the national income called problem of double counting. First time value is added in the form of intermediate commodity and second time it is added in the form of final commodity. To avoid the problem of double counting, only value of final goods to be included in the estimation of national income. I have tried to make this concept clear with the help of an example. Suppose a farmer produces wheat, its input value is 0. Whatever wheat is produced, its market value is rupees 500. Value added is equal to value of output minus value of input, means rupees 500 minus 0, 500. This wheat comes to the flour mill. He purchases this input of rupees 500, makes output of rupees 700, value added rupees 200. This flour comes to the bakery owner. He purchases 700 rupees flour, makes the bread worth rupees 1000, value added by him rupees 300. Now this prepared complete bread comes to the distributor. He purchases this bread from the bakery of rupees 1000, sells this bread in the market of rupees 1200, value added by this bakery owner is rupees 200. It means in this above case, total value of output is 3400, value of input is 2200, value added is 1200. We have to only take value added in the process of estimating national income, otherwise there will be problem of double counting. Next is value added method or product method. It is that method which measures national income by adding contribution given by each and every producing enterprise in an economy in an accounting year. After this, there are certain steps in this method. First of all, identify the different producing enterprises in an economy. Classify these enterprises into different industrial activities. Then estimate net value added by each enterprise as well as each industrial unit. Then adding up to the values by all these sectors. Now with the help of an example we can explain the concept of value added. As I have earlier discussed with you in the above video that the value added means total whatever value is added by any entity at the stage of raw material to stage of manufacturing, means whatever production taken place by business entity, whatever is the price of inputs used by that business entity, difference between two is known as the value added. Value added simply means addition to the value of intermediate goods during production process. Suppose a toys seller purchases plastic of rupees 400, makes toys with the help of this rupees 700. It means value of output, that is value of toys is rupees 700, value of plastic purchased by the toys seller is rupees 400, value added by him is rupees 300. It means value added means whatever is value added by each producing enterprise during the process of production. Now how the value of output is calculated? Value of output is simply calculated by multiplying volume of physical output, means whatever is produced its quantity with market price, and value of intermediate consumption is always equal to price paid by enterprise to purchase the raw material. Now what it should include, what it should not include. On account production of fixed assets by government enterprises and household should be included. Production for self-consumption to be included. Imputed rent of owner occupied houses must be included while we calculate national income by value added method. But sale and purchase of second-hand goods never included, as it is also in case of income method, but commission paid on them is always included in the estimation of national income. Now GDP at market price. When we add net value added by primary sector, tertiary sectors and secondary sector, we find net domestic product at factor cost, which is equal to value of output. Then we deduct value of intermediate consumption Then we have must deduct net indirect taxes from it. Then we are able to find national income by expenditure method. Next concept is circular flow of income in two-sector economy. Basically, circular flow of income means flow of income, goods and services in the different sectors of an economy. There are basically four sectors in an economy: producing sector, household sector, government sector, and rest of the world sector. Now I am starting circular flow of income in two-sector economy. For the sake of simplicity, it is only assumed that there are two sectors, that is producer sector, household sector. In case of two sectors in an economy, household sector gives factor services to the producing sector, and in return, producing sector gives goods and services to the household sector. When producing sector gives goods and services to the household sector for its contribution in the production process, it is also known as the real flow. But sometimes business sector does not give goods and services to the household sector for his contribution to the production process. Rather, he makes them factor payment in the form of rent, wages, interest, profit. When this payment is given by the business sector to the household sector, it is called factor payment. When household sector gets factor payment, he spends this money to again purchase goods and services from the business sector. It is known as the consumption expenditure. So when factor payment is given by business sector to household sector, and household sector makes consumption expenditure to buy goods and services from business sector, it is called money flow. Now there are different phases of circular flow of income. First phase is phase of production, distribution, disposition. In the first phase, production takes place by the producing sector with the help of factors of production. In the second phase, total income is distributed, means total income, that is whatever income is generated by the enterprise, it is distributed among the factors of production in the form of rent, wages, interest, profit to the factors of production. In phase of disposition, whatever income is received by the factors of production, it is spent by them again to purchase goods and services. It means phase of production means that phase in which goods and services are produced. Phase of distribution, in this phase income is distributed among the factors of production for their contribution in the production process. In the phase of disposition, whatever income is received, that is spent by the owners of the factors of production. So circular flow of income has three phases. One is production phase. This is a basic phase in which production takes place. After taking the production, whatever income is generated, after keeping a part of it distributed among the factors of production, this is the income phase. When income is received by the factors of production, it is spent, that is the expenditure phase, and it is spent again to purchase goods and services from the producing sector. So this phase goes into the circular manner. Next concept in the chapter number 2 is gross domestic product at market price. Gross means total, domestic means within an economy, product means production. So gross domestic product means, I am only telling you the meaning of gross domestic product, not at the market price. Listen carefully. Gross domestic product has three words: gross domestic product. Gross means total, domestic means within domestic territory of an economy, product means production. So gross domestic product means total production of all goods and services in an economy in an accounting year. but the concept is gross domestic product at market price. Gross domestic product at market price means market value of all final goods and services produced in an economy in an accounting year is called gross domestic product at market price. Now, there are two types of GDP, real GDP and nominal GDP. When the production of current year goods and services means GDP of current year is estimated at the current price, it is called nominal GDP or GDP at current prices. But when current year production of goods and services is multiplied by any base year prices, previous year prices, it is known as the nominal GDP, or it is known as the real GDP or GDP at the constant prices. I am repeating the meaning of real and nominal GDP. When current year production is multiplied by current year price level, it is called nominal GDP or GDP at the current prices. But at the same time, when current year production of goods and services is not multiplied by current year prices, rather it is multiplied by any previous year base year prices called real GDP or GDP at constant prices. Now the question arises, which is better indicator of economic growth, economic performance, or to compare the economic performance of two economies is real GDP or nominal GDP. Out of this, real GDP is the best indicator to assess the performance of an economy or to find out the economic growth of an economy, because nominal GDP is affected by change in the price level. Whenever price level increases, the value of GDP may increase, but the real GDP is not affected by the changes in the price level. Why it is not affected? Because in the calculation of real GDP, we takes only prices of base year, not the prices of the current year. So real GDP is the better indicator to compare the performance of two economies, to compare the economic growth of two economies. Now, basic formulas to find out national income. Basically, you should learn only three things. First thing is gross and net. Basically, gross and net are two different concepts, and difference between two is through depreciation or through consumption of fixed capital. Gross is a wider term, net is a narrow term. In order to convert the net, or in order to find the net from the gross, depreciation is deducted from gross and we find net. Second difference is difference between national and domestic. The difference between domestic and national is net factor income from abroad. Domestic is narrow term, national is a wider term. To make the domestic concept into national, you have to add net factor income from it. Third is market price and factor cost. Market price and factor cost are again two different terms. Market price means the value of a commodity assessed at the prevailing market price, and factor cost means the price or value of the commodity assessed from the point of view factor payment, that is paid to the factors of production in the form of rent, wages, interest, profit. Now the difference between factor cost and market price is of net indirect taxes. Net indirect taxes is the difference between direct tax and subsidies. When we deduct subsidy from direct taxes, we are able to find the net indirect taxes. Now, the another concept in the chapter number 2 is gross national product at market price. Gross national product at market price is generally slightly expansion of gross domestic product at market price. gross national product and gross domestic product are similar terms. There is slightly only one word difference, only one factor difference, only one variable difference. As I have told you, the domestic and national are differentiated through net factor income from abroad. Domestic is a narrow term and national is a wider term. In order to convert the domestic into national, you have to add net factor income from abroad in it. So gross national product at market price is the market value or money value of all final goods and services that are produced in an economy in an accounting year, including net factor income from abroad. Now, what is net factor income from abroad? Net factor income from abroad is the difference between factor income received or earned by our residents from abroad and factor income earned by non-residents within our country. Keep in the mind there are two things in this: residents and non-residents. I am telling you the meaning of residents and non-residents. Residents means which normally lives in a country, their economic interest also lies in a country. Non-resident means who are in India but their economic interest is not lying in India. So the income earned by our factors of production or factor income earned by our residents from abroad, factor income earned by non-resident within our country is called net factor income from abroad. Now there are three components of net factor income from abroad: net compensation of employees, net income from property and entrepreneurship, but other than retained earning of resident companies of abroad. First component is net compensation of employees. Second component is basically it is operating surplus, but how you define it? It is a net income from property and entrepreneurship. How it become the net? When we deduct retained earnings of the resident companies of abroad, then it become net income from property and entrepreneurship. And third component is net retained earning of resident companies abroad. Now there are certain formulas to convert the GDP into GNP, NNP into NDP, NDP into NNP. So I am written these formulas in a certain manner that you can easily appreciate them. NNP at market price. Suppose you have to find the net national product at market price and GNP is given in the question. To find out the net national product at market price from gross national product at market price, first of all try to find out the difference between word, means which word is making different these two terms. N for net, G for gross. Remaining words are common, means net national product at market price and gross national product at market price. So gross and net are differentiated through depreciation. There is only one word difference, that is gross and net. Remaining words are common. So to make the net national product at market price from gross national product at market price, you must remove, reduce or deduct depreciation from the gross national product at the market price. In the same manner, suppose in the question NDP market price you have to find, GDP market price is given, you again search what word difference in this. NDP market price, net domestic product at market price, GDP gross domestic product at market price. To make the net domestic product at market price from gross domestic product at market price, simply reduce depreciation from gross domestic product at market price, because gross is a wider term, net is a narrow term. To make the concept smaller, net, you reduce the depreciation from the gross, then you are able to find the net domestic product. In the same manner, to convert the domestic into national, you have to add net factor income from in it, and to convert the market price to factor cost, you have to use the concept of net indirect taxes. Now another concept used in the lesson is domestic territory. Basically, you have seen in lower classes, class 8, 9, 10, you have studied about the geographical territory. The territory which is shown on the map, it is basically political territory, geographical territory. But in economics, domestic territory is different from geographical territory. Domestic territory is wider than geographical territory or political territory, because domestic territory not include only the political territory, but it includes all the areas of operation generating domestic income, freedom of circulation of person, goods and capital. So domestic territory is a geographical territory administered by a government within which person, goods and capital circulate freely. Now the another concept in this lesson is resident. Resident word in bracket I have written normal resident, means the persons who normally lives in a country and their economic interest also lies in that country, or their center of interest is also in that country. Now center of economic interest means the resident lives within that country more than 1 year, and his center of interest also means his all the economic activities also in the favor of that country. Or basically, not to become the normal resident, you have to qualify the two things. First thing is you must be stay in the country more than 1 year, and second thing is your economic interest is also lies in that country. Economic interest, how create the economic interest means your earning, spending, accumulation from that country should be also within that country. Now I am repeating the meaning of normal resident. So normal resident is a person who, or it may be an institution, who generally ordinarily lives in a country and their economic interest also lies in that country. Now relation between domestic product, national product. National product and domestic product are two different terms. Domestic product concept is based on the production unit located within the domestic territory, operated by both residents and non-residents, whereas national product concept based on the residents and includes their contribution to production both within and outside of the country. Now next concept is calculation of national disposable income. Now to calculate the national disposable income, you must first of all find NNP at factor cost, add net indirect taxes, add net current transfer from abroad. Then net national disposable income will be available with you.